This program is sponsored by Wilsey Asset Management.
Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, good morning and welcome to the Smart Investing Show. I am Chase Wilsey, and joining me here shortly will be Brent Wilsey. Unfortunately, he had to run to the restroom. Bathrooms are broken on our floor today, so Brendan is going down to grab him real quick. So as I said, he'll be with you shortly. But we'll be here for the next hour, giving you that no strings attached, fundamental opinion about what you want to talk about. Very happy to be here this Saturday morning. Looks like a lovely day. Got a lot to talk about as always. We'll be talking about Rivian, that hot stock that came out, IPO'd a couple days ago. A lot of interesting news about that company. Also be talking about the CPI and inflation and how hot inflation is running. JOLTS report came out, one of our favorite reports. Very excited to talk about what's going on with the JOLTS. But as always, your calls do come first, and unfortunately, I don't have that phone number with me. Brent will be able to give that out shortly. Very excited to talk about what's going on today. But first, as I said, let's talk about what's going on with this Rivian company. And for those that don't know, that missed this IPO, Rivian is a automotive company. They're producing an electric truck is kind of, I'm going to say, their claim to fame so far. But let's say, Rivian has, actually, I got the wrong numbers here. Let me pull this up. Let's see. Rivian is an EV company that is going public within a week or so. Actually, they just went public. Got the wrong news here. Let me see what is going on. Let me move on here instead to the consumer price index instead. Consumer prices came out this past week showing an increase of 6.2% year over year. This was the worst climb in over 30 years. Now, unfortunately, wages year over year were only up 4.8%. A plan of increasing wages and the money supply to pay people more causes more inflation than people's increases in wages. I continue to see no end in sight for climbing consumer prices as the producer price index continue to remain at elevated levels with an increase of 8.6% in October. I do see inflation continuing to be a problem in 2022 with wages continuing to lag behind. So, hear a lot about inflation, and now Brent's joining me here. But again, inflation continues to be a big problem, and I as I said, I don't see it ending anytime soon.
Well, now, got stuck.
I already let
I let the listeners know what happened.
Yeah.
So now I'm kind of coming in. Okay, so so you just hit consumer prices, and I think you talked about a lot about it, but it's just something that we will kind of see. I think.
Just generally about inflation. It's just. We keep hearing about it and I keep saying it's like it's transitory. You've heard that word dropped, and it's not as frequent anymore. When it first, it's just transitory. Don't worry about it. Now you don't really hear this whole transitory argument any longer because, energy prices are high. You hear the administration, there's no plan to fix energy prices. They say it's a top priority, but we know that's not the case.
Right.
So I think that we're going to continue to see big issues with inflation.
I think 2022, which will be here before we know it, will be a difficult year. We could see, I'm hoping somewhat that maybe we do see some turnaround in the supply shortage, the situation we have on the all these ships off the coast. I think that will be resolved. We'll get through that.
I just don't know when.
Right.
It seems like this holiday season I don't think is going to help.
Right.
It's going to make matters worse. When is this shipping situation going to be resolved? Middle of 2022 when we kind of slow down from maybe consuming so many goods from the holiday season?
Yeah, I'd say probably the first, second quarter. I mean, we will. You get through these
There's so
things.
much of a backlash.
Right.
I think second quarter.
I keep hoping. We've talked about this in the past, where California will not let trucks that are 10 years.
That's not
older.
going to change.
Sorry
to let you finish.
I'm hoping that our governor will kind of realize, like, okay, well, let's try to help out here, and just for 6 months. I mean, in 2022, just okay, we'll reduce the emission standards just for 6 to 12 months until we get this resolved. But I can be hopeful, but doesn't mean it will happen, I guess. So, but it's frustrating, and I think it's not going to. And what's very important, and you know, I'm going to bring this up, and I saw this yesterday. Inflation hedges. You know, you've got gold, which actually gold did start to move. I am not going to stand behind that Bitcoin's inflation hedge. It is just crazy. And I don't know if we're talking about that today or not.
We're not.
Yeah, we're not. Okay,
But we will now. I mean,
Yeah.
you talk about, it's inflation. Bitcoin has never been around during an inflationary period.
correct.
So how can you say it's an inflation hedge? There's no data to back that up.
Right.
I mean, it's gone up during inflation this past year, but is that because of inflation or because the craziness of the market?
You know, and I'm going to say it's definitely not because of inflation. What causes the rise of Bitcoin is the enthusiasm that Bitcoin's going to go up. The people buying Bitcoin are not saying, "Oh, I'm going to buy it because of inflation." Maybe now a few are, but to get to that level, it was people thinking that they're going to miss out, FOMO, fear of missing out, that they need to get Bitcoin now. They were not thinking, "Oh, if I get Bitcoin, I'll be protected against inflation." And I do believe most of people buying Bitcoin and cryptocurrencies are on the younger side. So
I would say I know a lot of our older clients are like, "What's Bitcoin?" and I mean, I have conversations with people who are like, "I don't get it." And I'm
Right.
like, I don't get it either.
Right.
So I don't know. It's craziness. But speaking of craziness, I know we want to talk about Rivian. Unfortunately, the data you have on Rivian is incorrect. So I'm going to have to go ahead and
which
read
data is that?
it was actually data from one of our topics last week. So I do have the updated.
Oh, okay.
So I was scrambling while you were gone because I started
Yes.
looking at the data and I was like, oh, that is from last week. So our listeners are like, gosh, what is this Chase guy talking about?
I know what you're talking about because again, it got outdated very quickly. So I'll let you start on that one. Go ahead.
Yeah, so I'll go ahead and kind of talk about Rivian, give a little intro into it in the beginning of the show. But we keep talking about this craziness in the stock market, and this is just further proof. As Rivian has seen its market cap climb past $120 billion. For reference, General Motors has a current market cap of about $90 billion, and Ford has a current market cap of about $80 billion. Now, this comes as Rivian has no track record, and through October 31st has delivered just 156 total vehicles. Now, with all the hype in this market...
But wait, those 156 vehicles, who they sell them to?
That's a great point. The 156 vehicles were sold to their employees. So
Were they sold or given?
I think it was a combination because they did have some revenue, so I
Right.
assume it. Maybe they gave them to them at a discount, but just craziness. But we keep saying with all this hype in the market, it reminds us of the famous Warren Buffett quote that says investors should be fearful when others are greedy, and greedy when others are fearful. I'd have to say here, investors are definitely acting greedy in parts of this market right now. I wouldn't say too many people are fearful at this time.
Right. And we're getting these levels. I don't think we talked about it here. I don't think we talked about it last week. But this is just another sign that we are going to have the hype investor is going to have a very difficult time in 2022. These are signs, reminds me of back during the tech bust when it was happening. You had these craziness things right before it. And here we, again, a company that is worth more than General Motors or Ford that also has no sales, no earnings, let alone no earnings. They do have a good balance sheet, I think, because of all the IPO and everything else that they did. But and I talked about, I think, last week, I don't think we covered it here on the show, about this company. I set up a fund you can invest in for sneakers. Nike sneakers going for $1.5 million a pair of sneakers worn by Michael Jordan or something. So it's just, these are signs that there's way too much money in the economy. It's not going to stay there. It's going to go away. And when it goes away, all these people that have all this money, they're going to pull back on investing because they won't have it. And then things are going to fall. What will stay is your strong value companies. And again, they may take some type of a hit. But you're going to see, I do believe it's going to happen next year. There's going to be a lot of changes on some of these high-flying companies, cryptos, the meme stocks, all this craziness, I believe is going to be going away. Could be the end of next year, could be the middle of next year, but this hype does not last forever.
I mean, it's just crazy. I mean, you talk about Rivian right now. Their facility is really only set up to allow for about 150,000 vehicles annually to be produced. Well, talking about GM, they sold 6.8 million vehicles last year. Ford sold 4.2 million vehicles last year. How in the world can a company be valued at more than these two companies when the, I'm going to say, run rate to get to that type of capacity is decades away?
Yeah.
I mean, you're talking about billions and billions of dollars in capital expenditures that you need to do to get to that type of million vehicle run rate. Well, 6 million vehicle run rate.
Right.
It just makes no sense. And people that are riding the wave of the hype, yeah, it's so exciting, and I made money on it so far. Think to yourself, how does that make sense?
Right.
And we talk about competition. It's not like there's no competition in the space.
Well, Chase, I got a good word that there's never going to be another new EV company coming out.
Oh,
Yeah.
very good. Very
Right.
good. Well, what about Ford?
I
They
know.
have the F-150 Lightning. They have right now 150,000 pre-orders for that car. What did I just say? 150,000 is what Rivian can make per year. And they're not even set up to do that just
Right.
yet. I mean, it makes no sense.
It makes no sense. And again, I was obviously joking about there
I
is
know.
going to be no more
I know.
EV company. There will be. You've got General Motors. You've got. I can't wait. I think the Hummer comes out pretty
Later
soon.
this year.
Later this year. Well, actually, this year
I know, it's
pretty
coming
soon.
up,
Yeah,
yeah.
we're almost mid-November here. So, but you got that. You've got Porsche, Mercedes, Audi.
And I will say Porsche and Mercedes don't. I'd really say that they're competing more against Ford, GM,
Right.
because I will say they're a little bit different. They don't have the smaller cars like Tesla. They actually have an SUV and a truck.
Right.
I haven't seen Porsche release anything that's similar to that. So
Do we know what the Rivians go for? What their price is?
I
The
actually
basis?
do. Yeah,
I've not seen
let's
that.
see. So their SUV goes for about 70,000 is what the price starts at. So again,
Okay.
it's by no means a cheap vehicle, and the pickup truck starts at 67,500. So again,
both.
it's not a inexpensive vehicle by any means.
Right. Yeah. Just a lot of competition out there. And doesn't Warren Buffett say something about a moat?
Yeah.
There's no moat here. I mean, it's
And
like a wide open ocean.
I mean, you talk about the Hummer. I think that is the coolest vehicle.
Right.
I mean, I'm really considering getting one because
Well,
they are so cool.
It's funny, when I first came out, I thought, well, I think I want one of those. I think it was out for just a few days. I went to the website, sold out already. Too late.
Yeah.
So, and I think that will be something that's phenomenal. So hopefully that does come out, does very well. And that's the other thing too that we talk about. Hopefully that comes out and goes well. What is a Rivian? They're out with 10,000 cars, and all of a sudden they have a battery fire problem. Something. It's not going to be good for the investor.
Or you've seen Lordstown Motors. They've really hit speed bumps, and their deliveries have gotten delayed, and they're kind of, sorry here, Brendan, but they're kind of immune from the Tesla problem of delaying deliveries,
Right.
where Lordstown's just gotten crushed. And I think that Rivian doesn't have an Elon Musk type CEO that people love. So I think that if they have delivery issues, I think that that's going to be problematic for the stock. So we'll see what happens next year. But I was going to say, we don't have time to kind of talk about it further. We did cover this on our YouTube channel yesterday and kind of gave some other numbers that might be quite intriguing to you. So if you find this Rivian topic interesting, be sure to go to YouTube, type in Smart Investing with Brent and Chase Wilsey, and watch our weekly stock analysis video there. I try and do that on a weekly basis. Kind of missed the last couple of weeks due to me missing for football.
which unfortunately is over. Yeah, we don't
want to talk about it.
Okay,
So.
we won't talk about it, but that was your last game last night.
Yeah.
We'll put it that way.
Yeah.
Okay. Devastating loss. So, but let's move on, because last week we talked about the jobs report, and I mentioned that, and I think we saw there was 7.6 million people that still had not had jobs yet. And I said, well, gosh, I wonder.
7.4.
Oh, it's pretty close. 7.4. That's from memory. So 7.4 million. So I thought, gosh, well, what's the JOLTS report going to be next week? Well, we have the JOLTS report, and JOLTS again stands for Job Opening Labor Turnover Survey. We've been talking about this and how openings that people are unemployed. But this month, the quits rate is what caught my eye. the job opening still stands at an elevated 10.4 million people. So we need 3 million more people than what actually have employed, which is near the record high of 11.1 million people and still above the people that's unemployed at 7.4 million. But the big news was the quits ratio. What's going on here?
Yeah, I mean, this is crazy. The total number of people that quit, 4.4 million. This led to a record high quits rate of 3%. And again, that 4.4 million, again, that's a record. I mean, we have
Right.
never seen that many people quit before. And the thing that people need to understand is the quit rate shows the percentage of workers leaving their job. 3%. I mean, that's
huge.
Pretty
Yeah.
darn high.
Again, I've never seen it that high. I mean, and things were kind of changing. Is what's going on.
Yeah, and the thing you have to look at here is at these levels, it shows how comfortable people are leaving their job, as it's likely another opportunity is just right around the corner. I mean, you're not going to quit your job and be like, well,
Yeah.
now I don't have a job.
Yeah.
That is a sign that we have a very, very strong job market, not to mention, again, the amount of jobs that are open. I mean, there's a lot of competition out there for, good jobs.
And you can't go hardly anywhere without saying help wanted, help wanted. You hear it all the time about different employers trying to do different things to get people in. So people know that, like, a job, I don't want to say it's worthless, but like if an employer's not nice, like, I'll just go get a job somewhere else. So it does allow people to say, not worth it, I'll move on. But then the vaccines are another one. I mean, we can't tell, but how many people perhaps quit because of the fact that they were forced to maybe get a vaccine.
Yeah,
vaccination.
I do wonder. I mean, it's not going to be the 4.4 million that quit, but you can't deny that a percentage of those 4.4 million, some of them likely stemmed from the vaccine mandates. So they're like, I'm not getting the vaccine, I'll go get another job. But I was going to say the other thing too is right now the employees really have the upper hand in negotiations, I would say.
Oh yeah.
With the labor shortage, it's like you can't find people to work. So this is a great time for many people to get higher wages. And, kind of, as I said, they have the upper hand. I was reading an article the other day that said a lot of people quit and they'll say, well, I really want to go work from home. So they'll go find a job that allows them to do that. Or they say, I think I'm being underpaid. Well, they'll go get another job that pays them more. So there's a lot of competition out there. Again, a big benefit if you are in the labor market looking for a new career or a new job.
I'm just not having a good day today. My reader here that we use is all messed up. I can't find our program to actually get the visuals to actually go over the fundamentals.
I pulled it up for you before you came in.
Yeah, and I went to it, and now I can't find it. It was there, and I put in. Well, let me do this. Let me open the phone lines. 866-577-2473. That's 866-577-2473. Phone lines are open. Give us a call for that unbiased, no strings attached, fundamental opinion about what you want to talk about. And we'll just get this quickly fixed here. See if you can hit the magic buttons there. Chase came over this side. We have, let's go out to Coronado and speak with John. John, you're in the Smart Investor Show. Brent Chase, how can we help you?
Yeah, hi guys. Tell you what, good morning. I'm looking at Caterpillar here, kind of an infrastructure play.
Okay. And actually, I'm getting a lot of static. Is that on your end, John, or is that on our end, Brendan?
I'm not entirely
Must
sure.
be-
Sorry.
Okay. I think I'm just going to go home. Okay. I get stuck in the bathroom. I can't.
Well, but he wants to look at Caterpillar at least.
Caterpillar. Okay. And John, well, I know we got some static there, but I think you said you think about an infrastructure play. Is that what you're thinking?
Yeah, well, I think with this, next $1 trillion that they're going to throw in the economy, if some of your John Deere or your Caterpillar don't benefit from that in some way.
Okay. You know what? I think I'm going to have Chase kind of take this, and maybe Brendan can come in and kind of help me get this on straight. So, Chase, go ahead and talk with John on this one.
Gosh, we are just a mess this morning. It's a difficult
Live
situation,
radio.
but,
Thank you.
Yeah. Let me pull up Caterpillar for you here, John. So looking at Caterpillar, I mean, we all know the name. They are in the farm and heavy construction machinery. Shares that are short currently. Percentage of float, very, very small, just 1.1%. Institutional ownership, 70.3%. Not surprised by that. I mean, a pretty big, well-known company. Looking at the PE multiple, a little disappointed, though. I like Caterpillar. Obviously, as I said, everybody knows the name, but the PE right now, 22.4, above the industry average of 19.1. Price to sales, also expensive at 2.4, above the industry average of 1.5. Price to tangible book value, well, that stands at 12.3. Looks a little high to me, but it is better than the industry at 22.5. And price to cash flow stands at 14.7, also above the industry average at 13.1. Now let's look at the growth rates. Wow, done very, very well. Over last year, earnings per share up 54.8%. The industry, however, has grown 75.7%. Over the last 5 years, earnings have averaged 54% growth per year, also beating the industry average of 36.4%. Now, sales over the last 1 year up 10.9%, being slightly below the industry of 11.2%. Over the last 5 years, sales have averaged 3.9%, also slightly below the industry at 6.1%. Looking at the dividend, you do get I'm going to say a nice dividend, 2.1%. It does beat what you're getting in the bank account, so not a huge dividend, but it's sizable. And they only use 44.5% of their earnings to pay that out, so I'm not worried about that dividend. Looking at the balance sheet, always a very important thing to understand. Current ratio, well, that stands at 1.6. It's below the industry at 2, but I'm good with a 1.6 current ratios. They do have a good liquidity on the balance sheet there. Debt to equity, well, that stands at 220%. That is very, very high. That is worrisome. But I will say, I've looked at Caterpillar in the past. They do financing for a lot of their heavy machinery. I mean, you see those machines they utilize.
Yeah.
Those things aren't cheap. So the financing is there. You would want to look at the operations. How much debt do they have on that? And what is attributed to financing, as that can skew that ratio there. Looking at the current price for Caterpillar, well, that's at $209.27. It has pulled back. I didn't realize that it has fallen actually a decent amount, as the 52-week high was $246.69, and the 52-week low, well, that's $169.19. Year to date, it's up about 17%. Slightly below what the S&P has done this year, but overall, I'd say it's done pretty well. Very curious what has brought them down. I have seen Deere also fall lately. Not quite sure what has led to those declines, but obviously looking at buying the stock, want to know why has that company fallen from that 52-week high down about 15-20% as well. As always, we do want to kind of look forward to see what we're paying for the future earnings of the company. We'll go to December 2022. I do see that estimated earnings per share is $12.29. We apply our 16.6 multiple to that. We get a target sell price of $204.01. So it is unfortunately still below the current price. Trades at a forward PE of about 17 times. It's not overly expensive, but it's not inexpensive. So I think I might watch it, see if it falls further. But at this time, I wouldn't be pulling the trigger on Caterpillar.
All right, John. Yeah, I know John
Got
has
it.
some. Yeah, you got it. Thanks for calling, John. Good to hear from you.
Got it. Thanks, guys.
Okay, bye-bye. Yeah, that was on his side. I think he might have been in now. Well, he's in Coronado, so maybe sometimes Coronado doesn't have the best reception.
I don't know.
Maybe.
Yeah.
So, alrighty, phone number is 866-577-2473. That's 866-577-2473. Let's go to Lamita and speak with Arturo. Arturo, you're on the Smart Investor over at Chase. How can we help you?
Good morning. Good morning. My question is on electric vehicle charging company EVGO.
Okay.
It jumped a lot in this last week, and I own it, and I'm thinking whether I should just hold it, or since it went up so fast, can it also come down so fast?
I think we saw in the EV market because of Rivian. I think a lot of, I'll say not sympathy, but a lot of people they kind of rode the wave, and that could be why. So,
Well, I'm gonna.
You got something different?
The reason I believe, because there's another charging station company called Blink, and they also jumped substantially. But the reason for that is the infrastructure. The infrastructure
Right.
past the house, and in that is the charging stations. So I believe, well, okay,
Right.
it's riding the hype of the infrastructure deal, which now all President Biden has to do is sign it. So that looks very clear to be passing, and money will be flowing into charging stations. So I think a lot of that is now getting baked into the
You know,
companies.
and somebody brought up a thing yesterday, and I don't know if it's true or not, but saying that the charging is not universal. It's not like when you go to gas pump, all the pumps fit in the same hole. With the charging stations, I heard some cars are different. So, like, I guess Tesla, you can't use for other EVs. So, are we going to have like all these different EV charging stations around the country? Yeah. So,
I don't know.
just a side note there, but I did pull up how do you say
What?
EV Go? What?
I don't know, because we have charging stations out front of our office, and I see people with Teslas and then other cars there.
And I don't know. I read that from somebody else, and I kind of question it. So
I wonder if Tesla just is their charging stations are only for Teslas.
I don't know.
But I don't know how you make it a different fit for that one and not a different.
that
I don't
if
know.
you have it's funny. I was driving in this morning, and I was just kind of looking at how many EV cars are driving around me. There wasn't very many. I did see the Ford Mustang, which I hate saying that because it takes away that
I'm just gonna
name.
call it the Ford Mach-E.
Yeah, there we go. I saw that one. But okay, so say you pull up to a Tesla station with a Ford Mach-E, as you want to call it. Can you use a Tesla charging station? I don't know. Yeah, so it's something I kind of think about. Anyways, let's look at EV Go, I think is how you say this here. The symbol is EVGO. They are in the specialty retail industry is where they're putting these companies. They are 34% owned by institutional. Last full reported period here I have is March 31st of 21. So that's kind of strange. I don't have any more
strange.
updated data here. Perhaps they're not reporting data. I don't know. We do see that there is no PE ratio. They do not have any earnings at this point in time. Industry is at 39.2. Price of sales over 100 versus 1.2. Price to book value 90.1 versus 7. So very, very high valuations here. I do not see anything on earnings or sales growth. They do not pay a dividend. Let's take a look at the balance sheet here. Current ratio 0.5 versus 2.3. Now, Arturo, that is not very good because what that means is that they could be having a liquidity problem to where if they're spending out more money than coming in, they could have a liquidity problem. So be very concerned on that. Debt to equity, not too bad, 0.8 versus 1.2. We do see, let's see, this is, days inventory, 0.7 versus 127. That's pretty good, but I'm not going to look at that for this company here. Net profit margin, negative 336 versus a positive 3.9. Return on equity, a negative 68.2. I mean, these EV battery makers and so forth, they're very high risk now trying to find who's going to be in it. I don't assume there's any earnings going forward here, Chase, or what do
Well,
you
I'm going to start with the current price here at
Sure.
$18.90. It's close to its 52-week high of $19.59. Well off the 52-week low, $7.17. Now, market cap for this company is about $5 billion. So
Wow.
it's not small
No,
by any means.
I'm surprised it's that big.
Yeah. So it's definitely grown quite substantially. As you did assume, there is no estimated earnings for 2022. It looks like the first time an analyst gives it a positive earning estimate is 2024. But I was thinking about these charging stations as well when you were talking, and I just wonder about the margins.
Yeah.
How do they make money? And right now, the EV market's going to be kind of subsidized by the federal government. And people hate fossil. Oh, the gas stations rip people. Are people going to be complaining about EVs down the line? Or, those EV companies, they just rip people off in terms of the charging. And the other thing I was thinking about is how many people now start putting the charging stations in their homes?
Yeah.
So what is going to be the demand? And I think that we need to get this fixed. I do not want a EV if I'm going to Las Vegas driving, if I'm going to Phoenix. I don't want to pull off on the side of the road and wait for 40 minutes to charge my car.
Well, and the other thing, too, going down the road, no pun intended, what's going to happen is that the charging is going to be longer. I think right now 300 to 500 miles is like the max. Well, I think maybe in 2, 3, 4 years, it could be 1,000 to 2,000 miles. So that will change. But again, that means, well, hey, I'm going to do my charging at home because I can go now like a week and not worry about it. So this is why, Arturo, I don't like a lot of these future companies because they're hot now. But as we could just kind of dissect what could happen. So, 3 years from now, you get a car that can last 2,000 miles. Why need a charging station? So be careful there. These are high-risk things going out, and they sound pretty exciting. But I don't know, as Chase said, well, why would I ever use a charging station when I can do it at home?
Yeah, I'd say, Arturo, as you said, you made money on it. Congratulations. The question is, do you want to keep rolling the dice for another gain there?
No, just take some profit.
Yeah.
Yeah, take some profit.
Take some profit. Profit is good. Profit is good, especially when it has come up almost, double in the last week. And I know they hooked up with General Motors,
Okay.
and with Uber,
Mm-hmm.
and they're planning, the infrastructure bill is they're planning to build so many stations across the nation. So
Yeah.
Yeah, and will those stations be empty 5 years from now because you don't need them?
That's what I got to think about it.
Exactly.
Well, thank you very much for your information.
Okay, Arturo, thanks for calling. Have a good one.
Okay, bye-bye.
Bye-bye. All right, that does open up the phone line, 866-577-2473. That's 866-577-2473. Let's go out to Phoenix and speak with Roland. Roland, you're in the Smart Investor with Brent Chase. How can we help you?
Good morning. Well, since I'm in Phoenix, I'm up an hour earlier than you guys in San Diego now. And interestingly enough, I'd been looking at Caterpillar and John Deere this morning, and I grew up in Peoria, so familiar with Caterpillar. But John Deere, on the surface, looks like a screaming buy when you look to the forward earnings. And I think it's down because of the labor strike there, but it will probably get settled sometime. So I wanted to get your take. I've not had a chance to look at the financials on John Deere, but wanted to get your take because when you look at the forward PE ratios, it looks really promising.
Roland, and I do know they have a strike, and this is one time that we like to buy a good company because you said that the stock is down now. This could be a good opportunity. Now, maybe the strike goes a little bit longer, but this is what we kind of look for, a company that's on sale for what we call a fixable problem. We know the strike is not going to destroy the company. So let's take a look at the numbers here to see what we actually have. And I do see, and again, they're in the industry of farm and heavy construction machinery. The shares afloat very low, 0.6%. Institutional ownership, 78.4. We do have the last reported period is July 31st. The PE ratio right now on the trailing 12 months is 20.8 versus 19.1. Price to sales is high, 2.7 versus 1.5. Price to tangible book value is 9.8 versus 22.5. That is good. And price to cash flow is 14.6 versus 13.1. Now, the earnings per share over the last 1 year change is up 98.5%. That is better than the industry at 75. Even the 5-year earnings per share change is about 29.1 for the company, but the industry was at 36.4. The sales change for the last year, 19.5 for John Deere versus 11.2 for the industry. Over the 5-year, 9.8 versus 6.1. Now, here's a big positive. Based on the analysts, the 5-year earnings per share growth estimated to be 40.8%. That's about double the industry at 24. Now, looking at the yield they have, it's only 1.2. I wish that was higher. The industry's at 2.4. However, John Deere, they only use 19% of their earnings to pay that out versus the industry of 30%. Looking at the balance sheet, current ratio 2.2 versus 2.0. Debt to equity 310% versus 170%. But I do believe that John Deere probably does have, they probably loan for the vehicles and for the equipment and so forth. So some of that could be accounts receivable from the loans that they have with the customers. So you want to check into that just to verify that. We do see on their days inventory, very good, 80.4 versus 110. Days sales outstanding, 45 versus 80. And both of those you want lower, so that's good there. Net profit margin, 12.9 versus 7.7. Return on equity, very good, 34.6 versus 26. So I'm liking what I'm seeing here. Chase, what about what's the stock been doing and looking forward?
Yeah, so let's take a current look here at the price of Deere company, John Deere, $358.86, 52-week high, $400.34. So again, like Caterpillar has seen that pullback. 52-week low, though, $249.08, so still up quite substantially. And year-to-date, still a very strong return of 34.5%. And I remember looking at this, gosh, either last year or year before, but I know John Deere was kind of trying to do more in terms of reoccurring revenue, kind of like subscription-type stuff. So I think that their business model has improved, but it's definitely been reflected in that stock price. And now looking forward for the company, if I go out to October 2022, I do see estimated earnings per share of $21.66. Would give us a target sell price of $359.56, right about at that current level. But, you know, as I said, October 2022, that's right around the corner. We'll be pushing out to October 2023. I do see now that's estimated at $23.79 if we look at 2023. That would give us a target of $394.91, so above the current level. You know, but I would be maybe a little cautious on it. I don't know if I'd be ready to jump in just yet, Roland. I think I'd watch it a little bit more, kind of wait maybe until they report earnings. You might miss it, honestly, to be quite frank with you, but I'd rather be patient and get a great opportunity. Right now, I'd say it looks like an okay opportunity.
And Roland, the other thing I would look at, too, is that when I think of John Deere, I think of farm equipment. And you have to kind of look at the 10Q, the 10K to see how much of their equipment they sell is farm equipment, how much is for roads. You always think of Caterpillar as the big one. You see the cats all along the freeway when they got, construction going on. So before I jumped into this with an infrastructure play, I would want to know that number. How much goes to farm equipment? Because I don't think they'll benefit from the infrastructure play versus actually construction, to do roads and bridges and stuff like that. So that'd be one question I'd have. But I do like the idea of the strike because perhaps that can bring down the stock price. As Chase mentioned, also, we're going to be seeing new numbers here in probably a month or two that can project out to 2023. So I think it's worth watching and looking at, but I would not buy this level either. All ready?
Okay.
Roland, thanks for calling.
You.
Enjoy Phoenix. Bye-bye. All right. That does open the phone line. 866-577-2473. That's 866-577-2473. Let's go out to Normal Heights and speak with Mike. Mike, you're on the Smart Invest Show. Brent and Chase. How can we help you out?
Good morning.
Good morning.
I'm looking at Omnicom. It's OMC is a symbol. It's an older, established media advertising marketing company, and I'm looking at it as a value play. Good PE and a dividend.
All right.
Wonder how you thought about it.
All right. Well, now let's take a look at numbers here. Again, the company is Omnicom Group. A symbol is OMC. They are in the industry's advertising agencies. We do see institutional ownership very high, 94.6%. But you are correct, a nice PE ratio of 10.7 versus the industry over 100. Price of sales 1.1 versus 1.4. Note price of tangible book value. So look at the book value, 4.5 above the industry at 3.8. Price of cash looks good, 5.7 versus 10.5. We got a PEG ratio here of 1.2 versus 45. So that's a pretty good number there. Looking at the earnings per share change over the last year, it's up 45.2%. No change for the industry. Even the 5-year for Omnicom was 6.6%. Industry a negative 16.7%. So they're doing a good job growing their earnings. Sales, same thing. Sales 1-year change up 4.7% versus a decline of 3.2%. 5-year not quite as good. It was a change of down 1.5%, but industry was down 7.1%. So a difficult period there. The 5-year earnings per share growth estimate about 9.5% above the industry at 3.1%. So like seeing that. They do pay a nice dividend here. And I'm shocked by this. I did not think an advertising company would pay this type of dividend. The dividend yield is 4.1%. They use 42.6% of the earnings to pay that out. The industry is at 1.6%. So that's a nice juicy dividend. Hopefully they can sustain that. Looking at the balance sheet, current ratio is 1 versus 1.7. I'm okay with that. Debt to equity, a little bit worrisome here. It's 190 versus 110. And also, too, remember I said there's no tangible book value, so a lot of their assets are intangibles, could be the problem. So you got high debt, high intangibles. That could be something to kind of look at, to be worried about. We do see actually intangibles are 38.6% of the assets. We do see days inventory is 39.8 versus 16. That is not very good. We do see the net profit margin 9.8 versus 1.4. return on equity, very good. This kind of tells me about perhaps a low equity, 42.4 versus 9. Chase, what do you got going forward?
Yeah, I was just gonna say, I think this company is probably asset light. I
Yes.
can't imagine you need very much machinery or brick and mortar type location.
Right.
So I can't imagine they have a bunch of real estate. So I'm just assuming they're asset light, which I'm not gonna say makes an excuse for the debt levels and so forth, but kind of gives me an idea of why that is.
Right.
Now, looking at the current price here for Omnicom, it is $68.93. Has pulled back a little bit from that 52-week high of $86.38 and 52-week low, $56.65. Year-to-date stocks up about 13.6%, so it's done okay this year. Now, if I look forward for Omnicom, this is looking pretty darn good. 2022 estimated earnings per share of $6.46 would give us a target sell price of $107.24. So good estimated return there, Mike. Big question lies within that balance sheet, though.
And Chase, I didn't notice a trend of those earnings actually going up.
Yeah.
90 days ago, they're like 633. So that's pretty good on that. Yeah. So,
Yeah, and I mean, and you're seeing growth. I mean, this year you're looking at earnings growth of 24%. Next year, pretty low of just 3%, but year after that, about 6%. So, I mean, it's looking in the right direction. And as I said, I don't know if I can get over that balance sheet, but a lot of the other items look pretty darn good. Now, I would say another thing that concerns me, excuse me, is generally advertising is pretty easy to cut during downturns. And that's one of the first things that you can say, well, I'll pull back on advertising. So it's not, I'm going to say, recession-proof.
Right.
I don't see a major recession next year. I do think we'll have a slowdown here probably in a couple years, but just something to consider with this is if you had a pullback, I think this company would get hit pretty hard.
That is a good point to bring up. And the other thing, too, is that I would want to look at the financials a little bit more. I think this is worth looking at. I guess I'm attracted to the 4.1% dividend, pretty good.
And the 4 PE is amazing.
Yeah. So you got a lot of good things. I think it's worth looking at. I would not say it's a buy at this level. It does look pretty good. But you got to really look at that balance sheet. Again, Chase, a good point, too, about the advertising. That usually is the first thing that businesses on the slowdown will go back on. So I think worth the research here, Mike, but really check that balance sheet and understand the business a little bit more. All righty?
Well, the balance sheet, this is a service company, they don't have an inventory or big assets. So they're selling their service, which I think would explain the balance sheet, don't you?
Not really, because if you have debt and you have bills to pay, and you've got a high debt level and they want to collect that debt and you can't pay it, you're still going to have a problem. So they don't have the assets to maybe back that up, but maybe cash flow would be something to really look at. But yeah, debt is always important for a company. You want to make sure a company has liquidity to pay their bills, and also too that they're not being over leveraged with too much debt, whether it's a big equipment company or an advertising company. Debt can hurt a company.
Well, I'd say, their business model shouldn't call for much debt.
Yeah.
What did they take the debt on for would be my question as well. Why have they issued that debt? So I do agree that I would probably look at the cash flow to see, what does that look like in terms of paying off those interest payments, in terms of paying off those future liabilities, as there's not really the assets to back it up. So I look at the cash flow and, again, understand why do they have that debt.
Yeah. Okay, Mike?
Yep. Good point.
All right.
I appreciate it.
All right. Thanks for calling, Mike. Have a good one.
You bet. Thank you.
Bye-bye. All right. That does open the phone line, 866-577-2473. That's 866-577-2473. Let's go out to San Diego and speak with Tony. Tony, you are on the Smart Investor Show with Brent Chase.
Yeah. Hey, guys. Good morning. Always a pleasure to hear your analysis on the weekends. My question was, when in listening to the discussion on different bump ups in these EV companies and the infrastructure, Solar Edge, which is related. When we talked about, or when I heard you talk about, isn't it easier to plug in at home? I'd say overwhelmingly. I think even the market research indicates something like 80% of electric vehicle owners actually do charge at home. Okay. So that question about all this money pumped into these stations, I think as soon as they extend the battery life of these vehicles, which happens every year. I have a 2.5-year-old electric vehicle, a Hyundai Kona, because at the time I could not afford a Tesla. But just the jump up in range since then has been extraordinary. So when you look at home charging and solar energy, that's why I looked at the Solar Edge. I've had it. It's bumped up to I think 360. I got it in 203. And I'm just kind of wanting your opinion, from an outside lens. Is it still a hold? Would you recommend cashing out profits or invest more?
Yeah, and I was going to say, you bring up a great point. We didn't talk about this during the electric charging, but that is pretty awesome. I would love not to have to go to the gas station anymore. It's such a pain in the butt when you're just sitting there and you're like, I got to go, and you want to find a place that's not too expensive. I mean, we were driving down Miramar Road today on the way to the station. One station was at $509.
Oh, I know.
I was like, holy cow, that's expensive. So.
Yeah, and have you tried gassing at a Costco recently? Have you seen the lines at a Costco gas station?
It's because their prices are good, so everybody wants to go there.
Goes there. And it's funny because I know people do complain about going to a charging station for EVs because of the fact that it takes a long time to do it, plus there's lines there. But now with the Costco's, I mean, you want a good price on your gas, you're going to wait probably, I'll say at least probably 15, maybe 20 minutes to fill up your car. So, and I think you're saying Solar Edge, what they do is they create a system at home using solar to charge your electric vehicles.
Correct. Many of the Tesla owners that I know, they have solar-powered homes. In other words, it really doesn't cost them anything, and they can plug in at any time. I don't have solar energy at home. However, through SDG&E's pricing structure, and everything is app-based, the technology is extraordinary. You just program it to charge from midnight to 6. You can do it a few times a week or every day if you want to, and it's always fully charged. So I never have the concern of running out of quote unquote energy or juice or the equivalent of gas, because I just charge it every other night.
Yeah, and
so I keep it fully charged, and it's at 238 miles max charge. I never use that in a single day.
Yeah, and actually, it's kind of an interesting company. So I do want to look at the fundamentals to see if we can invest in this or not, because I have a feeling it's probably going to be too pricey because it is in that solar energy thing, which we've been trying to find something on sale because we don't like to buy things unless they're on sale. But let's look at the numbers here. I do see that they have 83.1% institutional ownership. Unfortunately, P/E ratio well above the hundreds, same as the industry, and that's what we're running into these solar companies. Everybody wants them, so they bid up the price on them. Price to sales 11.3 versus 4.7. Price to tangible book value 18.2. That is better than the industry at 43.9. And unfortunately, price to cash flow over 100 for the company and the industry. The PEG ratio does look good though, 2.7 versus 15.6. Now, this is kind of surprising to me. The earnings per share change year over year is actually down 21.1%. Industry down 27.5%. 5-year looking a little bit better, 8.5% growth versus the negative 16. Sales for the company, 1 year change, 16.5% versus 3.8. The 5-year change, 28.6 on sales versus a negative 5.8. So the company's doing very well here. The 5-year earnings per share growth estimate by the analyst, 25.2%. No surprise there, but that is also above the industry at 21. Looking at the balance sheet, you got a current ratio, very good, 3.8 versus 3.1. Nice debt to equity, 60% versus 100% for the industry. We do see days inventory outstanding as a 93.1 versus 89.2. That should be lower. Days sales outstanding is 85.6 versus 98, so that is a positive. They do have a nice net profit margin of 8.2 versus 3.4. And return on equity also looking pretty good, 11.7 versus 7. Chase, what do you got going forward here?
Yeah, so current price here for Solar Edge, well, that stands at $362.41. Pretty darn close to a 52-week high of $377. Wow, interesting. That was achieved on January 8th of this year, so it hasn't hit that 52-week high since the beginning of the year. But 52-week low, well, that's $199.33. So, wow, big dip that occurred at the beginning of the year, and it has bounced back. But year-to-date return up about 13.6%. If I go forward for Solar Edge, I see 2022 estimated earnings per share, $6.97. Unfortunately, very, very pricey, as that would give us a target sell price of $115.70. So it doesn't quite fit the build here for a value company, Tony. I'd say if I was a growth investor, are looking at it from a growth stock perspective, I mean, you see the year-over-year growth here, 23.5% for 2021, 37% for 2022. So you're seeing good growth, and they have a clean balance sheet, but it just, as I said, doesn't fit the build as a value company, which we like to
I may
invest
have
in.
bought it. It seems like I bought it at the dip, right? I got it at 203, and you said the 52-week low was 199. So maybe was a value then. I just remember at that time, I think they missed an estimate, and typically, you know how the market overreacts on these quarterly reports. I think that's what happened there. And then, of course, now, you know, it's just had a huge run up. But maybe I'll just, you know, take the profits and run and look at a lower priced, more of a value. I know, especially on your show, it's very much Buffett, you know, value oriented. Finding maybe a growth prospect at a good value. Really hard nowadays, I think.
You're right. And we like to find things on sale, and there's not a whole lot on sale right now. But the other thing I was saying on this company as well, do they have competition? Is there other companies doing the same thing out there as well? So, but I think you're kind of leaning towards taking the profits and try to find a better value at this point in time. So, already?
Yeah, I do. I think now, kind of just hearing the numbers, I just kind of needed that outside opinion. I was leaning that way, and I think hearing the discussion of the numbers kind of nudged me over.
Cool. Well, Tony, thanks for calling. Have a good one.
Thank you, guys.
All right. Bye-bye. Alrighty. That does open the phone line, 866-577-2473. That's 866-577-2473. Let's go back out to San Diego and speak with Wayne. Wayne, you're on the Smart Investor, Brent Chase. How can we help you?
Morning, gentlemen. I'd like your opinion on Nucor. NUE is the symbol.
Okay.
And my reason is going forward, I see all kinds of different numbers. I've got, I understand but that's a year away before that kind of money is really going to affect the stock. You know what I mean?
Okay. When you kind of broke up there a little bit, I think I think we got what you're looking at there. So we're going to take a look at Nucor. Their symbol is NUE. Do see institutional ownership is 84.3. Not a lot of shorts on this, only 2.7. Very good PE, 6.7. Not quite as good as the industry at 5.7. Price of sales 1.1. That's above the industry at 0.6. Price to tangible book value 3.4, just slightly under the industry at 3.6. Then price to cash flow 8.2 versus 4.8. Now we have a PEG ratio of 0.1 versus 2.1. That is good. Looking at the earnings per share change over the past year, wow, 614%. Nothing for the industry. Same thing with the earnings per share growth, 5 years, 44.4%. So done a great job growing their earnings over the past year and 5 year. Sales, 1 year change up 29.9 for Nucor versus 18.1 for the industry. Sales on the 5 year change, 10.6 for Nucor versus 3.5. And analysts give it a 5 year growth rate of 34.2, well above the industry at 7.8. So that's a big positive there. They still have, they do not have a good dividend. Their dividend is 1.4%, but the industry has a dividend of 4.2. So I kind of mix those up. And the payout ratio is not that much different. The payout ratio for Nucor is 16%. Industry does it with an 18.3% payout ratio. So a little bit disappointed on that. I do say they have grown their dividend for 10 years in a row, which is a pretty impressive thing. They actually have not cut that dividend or reduced it. The balance sheet, current ratio, very good, 3.1 versus 2.2. Debt to equity, very good, 40% versus 60%. Days inventory looking pretty good, 92.3 versus 101.9. Days sales outstanding, 47.6, not quite as good as the industry at 44.7. We do see the net profit margin for Nucor, 11.7 versus 9.7, and return on equity is very good at 24.7 versus 18.5. Chase, what do you got for the earnings going forward?
Yeah, so current price here for Nucor, $112.24. 52-week high, $128.81. Wow, 52-week low. Well, that was $47.94. Year-to-date return up 113.9%. I do believe this one is riding that infrastructure wave as well. If I look forward for Nucor, estimated earnings per share in 2022, well, that's $14.67. Would give us a target sell price of $243.52, which looks phenomenal.
Right.
But I will point out, 2021, the company this year's estimated to make $23.54. So you're seeing a decline of about 37.7% in the earnings next year. And then following in 2023, estimated earnings dropped to 7.61, a decline of 48% from that level. The hard part with these steel companies, and the business is so cyclical, is that they almost look very attractive when the stock price is really high because their earnings are doing well. And then they almost look more attractive when the earnings don't look as good and the stock price is low. So it's a cyclical company that's really, really hard, I'd say, to value.
And what did you say that the earnings were in 2021?
$23.54.
$23.
Yeah.
I thought maybe that was a mistake because that sounds awfully high compared to what it was.
$7.61 in 2023.
That almost sounds like because I have a different program I look at. They only show $5.05. That number just seems like the $23 just seems very, very strange to me.
Yeah.
So I don't know. I mean, but still, with all that said, when you get some strange numbers, things don't look quite right. And again, how much they're going to benefit now is just all baked in with the infrastructure play. I mean, Nucor looks pretty good, but I don't think I want to buy it at this level yet. No. I think I'd be more patient. All ready?
And that infrastructure money is not going to take effect for anywhere from 12 to 24 months to do those big projects where the steel is really going to be used.
Oh, yeah.
Is my feeling.
Yeah. And actually, I think it can take even longer than that as well.
Right.
I mean, it can go up for years.
Some of those projects are that funding's over 5 to 10 years in that bill.
Yeah. So
can I make one comment about Caterpillar?
Sure,
From
definitely.
a construction standpoint, Caterpillar has the best equipment for performance and reliability, talking about maintenance, for your caller that called me about John Deere and Caterpillar. I'm not talking stock price. I'm just talking equipment.
And you know, I've kind of wondered that because, as I said, you see a lot more Caterpillar out there on the construction sites than you do see Deere. Maybe that's
my dad owned a construction company, and that's the only brand he would buy.
Yeah, and I kind of would say that would be true because I see that, but I would still want to know how much Deere does in construction. I still think they're mostly performance.
Deere does mostly agriculture.
That's what I'm thinking.
Right, yeah. I agree with you.
Yeah.
But those machines are very expensive. I mean, those combines can cost $400,000 or $500,000 for a farm. You know,
you can buy a Lamborghini for that.
You know, you can buy a lot of Teslas with that kind of money. Tell this call screener.
He's shaking his head right now.
It's his birthday today, and his
Yes.
one request is for us not to talk about Tesla. And I think
we did it twice. Twice.
We'll talk about Elon Musk selling stock on a drip method another time. Time, guys.
All right. Thank you very much for calling. Bye-bye. All righty. Gosh, we only got about a minute left, but happy birthday to Brendan for and doing such a great job here every Saturday for us on the Smart Investing
Thank
Show.
you so much. I won't quit this job, I promise.
Okay. And outside the parking lot, we got a Tesla waiting for you.
All right.
Well, we covered a lot today on the show. I'm very happy with the results, and I do have to apologize to Rose and Dave. We did not get to you today. It's been a busy day on the show. We didn't even do anything on Facebook today. But please, tune in next week. We'll get your calls. Try to call in a little bit earlier in the Smart Investing Show. We just love talking to people, and it's just we sometimes can't get to everybody.
Yeah, and I'd say we had the callers coming in nicely today. So
yeah,
we do, as you said, apologize, but it looks like we're shaping up for a good Saturday. Looking like the weather's kind of warm. Got the sun out there, so definitely have a good weekend here.
Yep, you got your smart investing information now, so now you go out and relax on the beach. I think it's going to be like 80 degrees or something today.
Yeah, I mean, you can't even buy or sell stocks today or tomorrow, so you're good. You know?
That's right.
Nothing to worry about.
And then Monday we'll hit it hard.
Yeah. Right. Not that we trade, by the way.
Right. Well, the research is what we hit hard. All righty, this is a closing bell. Thank you for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more details your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. Or visit our website. A lot of great information there. smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information along investment tips, go to our Facebook group page, Smart Investing with Brent Chase Wilsey. Have a great day. We'll talk more next week right here on the Smart Investing Show.
To think that I did all that, and may I say, not in a shop.
This program is sponsored by Wilsey Asset Management.